Hey, welcome to part 2 of this video series on how to repair a losing stock position using options. Now, if you haven't already watched part 1, I would suggest that you go and watch that video first, because in that video, I talk about what exactly repairing a losing stock position means. So that will set the grounding for this video. So if you haven't already watched it, just go to the top right hand corner of this video and you can click the video to watch that first. But if you've already watched it, then in this part 2, I will share with you the remaining 2 strategies for you to repair losing stock positions. And the second method is the put ratio spread. So what is the put ratio spread? Now, the put ratio spread just very simply means to buy one put option which is normally at the money or slightly out of the money. So imagine this is where the market is right now. So you will buy one put option and then you will sell 2 put options that's further out of the money. And you can see this ratio is where there's 1 and this is 2. So this is where you get the ratio, where it's 1:2. Now you can also do a 1:3 put ratio. That means you'll be buying 1 put option and selling 3 put options, or buying 2 put options and selling 3 put options. All right, so there's a lot of ways that you can change the ratio. That is why it's called a ratio spread. But for the purpose of this video, we're only going to be focusing on a 1:2, and I suggest that you do that as well, because this is much simpler and more straightforward to understand. So basically, a ratio spread, a put ratio spread, is where you're using put options and with a ratio that is either 1:2 or more. Now, you can see here that we are selling 2 put options. So this can be quite confusing and scary to some people. So instead of seeing the put ratio this way, the better way that I would prefer to see a put ratio is basically that it consists of 2 option strategies. And when you combine these 2, it becomes the put ratio spread. So first of all, the first portion of the put ratio spread is simply just a bear put spread, right? A bear put spread is a bearish strategy where you are hoping the market drops, right? The market goes down and that's where you make your money. And it is a debit vertical spread. That means you are paying for it. So as you can see, let's say this is the market right now. So buying a bear put spread basically just means you are buying at the money or slightly out of the money put, and then you're selling a further away put. Now this will always cost more than this. That is why you're paying more to buy this, and then when you sell this, you receive lesser, and that is why it's a debit. So what we want to do is to finance this bear put spread with the second component, which is a cash secured put. So a cash secured put is where you receive a credit for selling this put option. So ideally, what we want is to sell this and receive the credit that is more than what we paid to buy this bear put spread. So for example, if we bought the bear put spread for $1, what we ideally want is to sell the cash secured put for more than $1, right? It could be $1.05, $1.10. This way, we get the bear put spread for free. That means that anything that goes below here will be a profit for us. And even though if the market goes up, we wouldn't lose any money at all, because this is a credit spread altogether, right? So imagine this. If we receive $1.10 for this, and we paid $1 for this, minus $1, our total will become a credit of 10 cents, right? But if you only bought this bear put spread, and if the market decides to go up, right, then you would have lost $1 at expiration date if it closes above your bear put spread. But because we have this credit down here that is helping to finance the purchase of this, even though if the market goes up, we now no longer lose money, because we have a credit of 10 cents, which is $10 per option contract, right? So that is why we want to always route a put ratio for a credit. Now, the put ratio spread in general is a neutral to bearish strategy. That means that we want the market to go down. All right, so ideally, as a repair strategy, what we want is to get filled at the price where we sold our cash secured put. So we want the market to actually go down here. We want it to go past our cash secured put and expire below this put. This way, what will happen is that we will receive the max profit on this bull put spread, right? We will make the full profit here because this spread makes money as the market goes down. So if it goes down and closes below, we will take the full profit of this, and that leaves our cash secured put, and this cash secured put would be exercised, and we will now be long 100 shares at this level. Now, if you did not sell this put ratio spread and you were to just place a buy limit order to buy 100 shares here, all you would have is just you will be long once the price goes below this level. You will be long 100 shares, but you wouldn't have any profits. But with the put ratio, we would have already made profits from the bear put spread. So that is why a put ratio spread is a fantastic way for you to go long a stock, especially if you want to hold it as an investment for the long term. So I'm going to give you a visual demonstration, illustration, just to show you how it works. So imagine you are long 100 shares, right? This is Disney. You have bought 100 shares at $110, and now the market is really dropping. And in a bear market, when the market is crashing, you will face this quite a bit because most of the time, most of your positions will be up here. So now that you have long $110, you decide that, hey, I want to repair my stock position. So what you want to first do is identify the level which you want to buy at. So in this case, let's say we want to buy at $85, which is quite a fair bit away from $110. So instead of just placing a buy limit order, what we do is we are going to sell a put ratio spread. So as you can see, this is a put ratio spread. So again, we are buying one put, which is $92. So this is just slightly further out of the money, right, from the market, $92 down here. And then we're going to sell two puts at $85, which is the price we want to go long at. So remember again, it is basically a bear put spread and one cash secured put. So this spread will make money when the market goes down. So anywhere below $92 is where we will make our money. And if it goes below 85, on top of making the profits here, we will be long $85, 100 shares at $85 at expiration. All right, so let's take a look at a few scenarios that can happen at expiration. So let's say at expiration, Disney is above $92, right? It could be here, it could be there, right? If it goes above $92, what it just means is that our put ratio expires worthless and we get to keep the full 5 cents credit. Now you times this by 100 shares, that is $5. That is not a lot, but it's at least something, right? So this will bring our average price down per share to $109.95. Now this is if it expires above $92, which is not too bad as well, because it means that our existing position doesn't actually lose that much. So we kind of have zoned out, or rather boxed out, our price in the sense whereby if it goes up, it's not so bad for our existing position. If it goes down, we make money on our spread as well. So let's take a look at scenario 2. So let's say at expiration, Disney is in between $92 to $85. So this is the zone where we start to make money with our spread. So how much we make really is dependent at where it closes at expiration date. All right, so let's say it closes at $90 at expiration date. So that's $2 below the put that we bought. So in this case, our profit would be the 5 cents that we've already collected, plus the difference between the put spread that we bought and where it closed at. So it will be 92 minus $90. So a total will be $2.05 times 100 shares. That is total of $205. So we made $205, and at this point, this put ratio would have be expired. The cash secured put would have expired worthless. So when this happens, our average price right now becomes $107.95. And we are not even long yet at 85 because it did not breach our put at 85 strike. So what happens here is that we can just sell another put ratio spread to try and collect more premiums again as the market drops, or if the market goes up, it doesn't matter to us. We will still try and collect some money as the market moves, right? Now, what if the market closes at $87? Then, similarly, first of all, we will collect the 5 cents in credit, and then we will take the difference between $92 and where it closed at 87. And in this case, it will be $5, and that is a total of $505 that we get to keep, right? We get to keep, and we do not even have this put option exercise. So this brings our average price right now to $104.95. Our put cash secure put expired, worthless. So what we can do is again sell another put ratio, or maybe if you prefer, you could sell cash secure put. Now let's take a look at scenario 3. Now what happens at scenario 3 is if Disney was to close below $85, and this is where our cash secure put is. So when this happens, our profit will be the full profit of this vertical spread that we saw, the bear put spread, which is a total of 7 points from $92 to $85. So we'll be making a profit of 5 cents plus $7, total of $7.05 times 100 shares, that is $705. And when that happens, we will also be long in the 100 shares at $85 because now our cash secure put gets exercised. So in this case, our average price now becomes $93.98. Basically, you just take $110 plus the $85 that we went long at after we got exercised at the 85 strike, and then we minus off the credit, the total credit that we receive, and divided by 2 because it's 200 shares altogether. Divided by 2, and the average is $93.98. So as you can see, we have significantly reduced the average price from $110 to $93.98 just by selling a put ratio. So this can definitely help increase the probability of you getting break even a stock, because it's much easier for the stock to go up to $93.98 than it is to go to all the way to $110. So this is the put ratio spread. Alright, repair method number 3 is deep in the money call lips. Now if you don't really know what is lips and what is deep in the money, I suggest that you go and watch the other video which I've already created. It's about leaps, where I'll tell you everything you need to know about leaps there. So the reason we want to use deep in money call leaps to repair is because you get to put up lesser capital than buying shares, which means that there is lesser risk. So let's take a look at this stock right here. This is XBI, which is the biotech ETF. So if you were to just go long right now to buy 100 shares, you will have to put up, $80.67 times 100 shares. That is a total of $8,067. You have to put up this cash if you want to go long at this price. Now, instead of buying just full 100 shares, what you could do is to buy call leaps, right? So call leaps, as you can see down here, these are all the call options, and leaps basically just means where the days to expiration is more than a year. So as you can see, this is 557 days, so that's well over a year. So there are many different strikes that you can choose from. You can see down here, you can go from paying very little, just $12.70, right, which is basically $1,270, all the way down to $49.50, right, which is $4,950. Okay, so for this 49 delta call leap, which is slightly out of the money, which is considered at the money, you'll be paying $1,225. Now this is the bid and ask spread. If you notice that the bid and ask spread is quite big, close to $1. So that is why when you want to route an order, every time when you route an order, especially on leaps where it's less liquid, than the nearer to the lower expiration dates, like 45 days or 30 days, compared to that, this is generally have a wider spread because it's not as liquid. So in this case, you never just want to take off the offer down here, which is the ask. So the ask is basically where the seller, the lowest price where a seller is willing to let go of the shares. Now most of the time is the counterparty is always a market maker. So you can see the market maker has deliberately made the spread very wide because they make the difference between this. So if you want to buy it off right now, the readily available price is $12.70, which is $1,270. You do not want to buy off this price. Instead, you want to take a look at this price, which is the mark price. So you always want to have a column which says mark, which is basically just the mid price. So you want to start off getting the option at this price. So for this 49 deltas, you'll be paying $1,225, and that is a fraction compared to what you will pay if you pay 100 shares, right? 100 shares is $8,067. Now you could go to the 71 Delta call leap. So in this case, you'll be paying $2,330. And you could also go to the 89 Delta call leap, which is $4,010, slightly more expensive. But the one that I would suggest that you go with is this one, which is the $89. Basically, you want deltas that are very high, 80 and above. And the reason for that is this column right here. Now, this column is the extrinsic value. When it comes to options, you must always take note of the extrinsic value, because extrinsic value is basically just time value. If you are buying options, you always want to buy as little extrinsic value as possible. And if you're selling options, then you want to get the most extrinsic value as much as possible, because this extrinsic value will go to zero once it expires. So once it becomes zero, when it expires, all extrinsic value will go to zero. So this is the premium you have to pay for getting this kind of leverage. So when you're buying the option, especially when you're buying call leaps, you want to pay as little extrinsic value as possible. And the reason is because each day, if the stock does nothing, you'll be losing this. This is what you call time decay. You'll be losing money every single day, right? So you definitely want to lose much lesser compared to down here. And we want to buy this. If you were to compare this to this, you will see the difference in terms of what you'll be losing on average per day. So if I were to take up my trusty calculator, all right, let's just calculate this very quickly. Let's say, for example, you decided to buy, the 80 Delta, sorry, the 80 strike with the $62. That is roughly $1,728, right? $1,728 is what you'll be paying in terms of extrinsic value. And you divide this by 557 days. On average, you'll be losing $3.10 every single day, right? But if you were to buy, let's say, the 89 Delta, this one, it's 4.43. So that is $443, and you divide it by 557 days. So on average, you'll be losing only 79.5 cents per day, which is much lesser than $3.10 here. So if you were to buy the at the money call leap, right, although you are paying lesser, the stock has to really move quickly, because otherwise you'll be losing quite a bit every day, right? But if you bought the deep in the money call leap, the time decay, or the value of the option that is decaying, is lesser every single day compared to at the money, because most of it is the intrinsic value, right? You're paying for mostly the intrinsic value. So this intrinsic value basically is just the difference between the stock price, the current market price, and your strike price. So let me take out the calculator again so you can take a look at this. And again, this is very important to understand. When you're buying options, you want to buy as much intrinsic value and as little extrinsic value. And when you're selling options, you want to sell as much extrinsic value as possible. So if you were to buy the stock right now, it's 80.67, right? 80.67, this is the ask, and you minus off the strike is 35. So you can see it's $45.67 in intrinsic value. So you can see exactly it's $45.67. Now this intrinsic value does not go to zero at expiration date, because intrinsic value is basically just the difference between this price and your strike price. The only time this will go to zero is if the stock goes to zero. So basically it's the same as holding stock. So that is why when you hold more intrinsic value, you're not bothered that much by the time, because this, all you do is just minus this and the strike. But extrinsic value will always decay. Okay, so that is why we go for the deep in the money call leaps when we want to do a stock repair strategy. So let's take a look at an example so you can see exactly how it's done. So again, we use the same example. You're long 100 shares at $110 over here. Now let's say the first step, you want to identify the level you want to buy it. Okay, so again, $85. We think $85 is a good place to buy. So what we want to do is we look for the longest dated option, the longest DTE, days to expiration, and then determine how much you want to pay for the leap. So let's say, for example, if you decide you want to pay $4,000 for the leap, all right, so that's $40. So what you do is you would find the 45 strike price and then you pay, and then you queue in the order for $40. So this way your break even will be at 85. Now if you want to pay only $3,500, you just put in the order at $35. This time you have the strike of 50, and $3,000 again $30, queue in the order at a strike of 55. You notice that if you add these two together, it's always 85. So this ensures that the price, or rather the break-even price that we are buying at, is always at 85. Now, of course, there is the extrinsic value portion, so that means the market may have to drop much further below 85 before you can get filled. So this is step 2. Alright, step 3, all you have to do is just simply place the limit order, as you can see down here. So if you have decided that it is $3,500, and in this case I went to take a look at Disney, and Disney lowest strike price is 50 for the furthest dated option. So in this case I only can go as low as 50, which is roughly 90 deltas, and I queue an order of $35, which is $3,500. Right, so $3,500 is the risk. So even though it goes to zero, then the most I can lose is only $3,500 plus, of course, this $110. So that's all you have to do. So it's much more simpler by placing deep in the money call lips for repair. Alright, so let's put this all together, come to a conclusion. So repairing your losing stock means to lower the average price of your stock. Okay, so what this does is that it increases the probability of break even, because as the average price is lower, it takes a smaller move for your stock to get to your break even price, and you also get a higher profitability above your average price, because now you're getting more shares, right? You're getting more exposure to the stock. But make no mistake, this also increases your risk, because you're actually putting up more capital, right? So if you hear other people that says, you know, repair your stock is a guaranteed way to make money, don't listen to that. Take that with a grain of salt, because you need to understand that at the end of the day, the success of this strategy is dependent on whether the stock actually goes up or not. So if you chose a stock that will go to zero, then no matter how you repair, chances are you're probably not going to make back the money that you lost, right? So this is one thing that you have to understand, and that is why we only want to repair stocks that you are confident in holding for the long term, that you want to invest in. And usually this is where the stock is fundamentally strong, it has a good profit record, is always growing its revenue, growing its profits, and your view on the stock hasn't changed. Now, if your view on the stock has changed, then it's better to just take your loss and move on to another stock. You don't want to repair and add on to a stock that's eventually going to lose you more money. That does not make sense. So this is important when it comes to repairing your stock. And finally, there are 3 methods to repair your losing stock positions. You have the cash secured put, where you just receive your premium, you receive a credit upfront, and wait until the price goes below your cash secured put strike price at expiration for you to get filled. Repair method 2 is the put ratio spread, which you have just learned, where you have a embedded bear put spread where you will make more as the market goes down. And then repair method 3 is the deep in the money call lips, where you want to go for delta that is roughly around 80 or more and pay as little extrinsic value as you can. This way you will not be losing that much each day. You give yourself a chance for the market to rebound back up and overall make a profit. Alright guys, I hope you like this video. If you do, please give me a thumbs up. I hope this has been so helpful for you that you can go ahead and implement some of these methods to your stock positions right now. So if you want to hear more from me, you would like more of this video, please click the subscribe button as well, so this way I can create more videos just for you. Alright guys, thank you. I appreciate your time, and I'll see you in the next video.